everybody, and welcome to this special episode of Prinsights Global Spotlight, where I am so thrilled to introduce a good friend of mine, John Butler. John is the author of an incredible classic book on gold you should all consider buying, which is The Golden Revolution. It was first published in 2012, and its second edition came out in 2017. It's available on Amazon and anywhere online you may wish to go to find it, but you definitely should. He is also the publisher of the Substack, the Amphora Report, which I follow and which is a treasure trove of information about the macro environment, commodities, and everything else in between from his incredibly unique perspective. John, thank you so much for joining us here today.
Oh, my pleasure, Noe.
So, John, you have had a really interesting background. You've done a lot of things from Wall Street Times at Lehman Brothers through various projects that you're doing right now, including the Amphora Report, Substack. Can you give us a bit of a background on that evolution and what's led you to what you're doing today?
Well, I had a fairly traditional macro investment background that began on Wall Street. My first job was on Wall Street. And after a few years there, I had a bit of wanderlust. I got invited to move across the Atlantic to Germany to work for a German bank that was trying to get more international in its macro offering to investors. And I spoke German, so I thought, oh, I'm a young guy. I'm looking for adventure. Let's do this. And then I never came back to the United States after that. One thing led to another. That German bank eventually moved me to London. While in London, I was headhunted by Lehman Brothers. Got out of Lehman Brothers almost exactly 1 year before it blew up and was at Deutsche Bank instead, which fared somewhat better in 2008 than Lehman Brothers did. And then after that, though, when things did blow up, I became very, very dissatisfied with the industry. I didn't like the idea that everybody who made bad decisions was getting bailed out by taxpayers, was getting bailed out in ways that ultimately would prove inflationary. And I didn't want to be part of the problem anymore. I wanted to be part of the solution. And so I started working independently. I started my writing. I basically worked as an investment consultant. Then I got involved in gold-backed fintech, which I thought was really an area with lots of promise. And I did that for about 6 years. And I'm still advising, by the way, some gold-backed fintech firms, as well as high net worth investors and institutional investors, primarily about how they can and should, in my opinion, best integrate precious metals and other commodities into their investment processes so as to solve the problem that everyone is facing today, which is, what do you replace the traditional 60-40 portfolio with? Well, I've been writing for years about what you should replace the 60-40 portfolio with. And so that's a core part of my business today.
Yeah, and it's interesting because that evolution actually is similar to mine, but you were so ahead of me in getting into the gold elements from the macro side and from the Wall Street side. And I totally agree with you about the problems with bailing out financial institutions versus looking for real assets, real investments, and sort of the real world for investment opportunities. And you spent a lot of this year, specifically in Amphora Report, in your Substack newsletter, dissecting sort of the structural breaks in the US, in the UK, et cetera, because of the debt accumulation, because of how there's been so much fiscal deterioration, budgets are so high, and reserve diversification away from the dollar and fiat currencies. And what do you think is on the horizon for that? Clearly, there's been a lot of ground covered this year with gold appreciation, but what do you see coming?
Well, look, we are on the road to an eventual de facto gold remonetization. And I know that remains a controversial view to this day. Yes, that's the core thesis of my book from 2012 and the revised edition from 2017. But if you ask me, we've been passing one milestone on the road back to gold remonetization after another. And the big bull market we saw this year is a reflection of what I believe is a fundamental shift in the demand function for gold. That is, regardless of the level of interest rates, regardless of the level of inflation, regardless of the level of any specific investment risk return trade off, demand for gold has simply shifted. It shifted on the part of central banks, and they have very good reasons to do that related to the risk of sanctions. If you're not under sanctions today, you might be under sanctions tomorrow, and you want to be prepared for that. And then when it comes to large institutional investors, many of them are constrained in their investment processes regarding how much gold they're allowed to hold and in what form they're allowed to hold it. Well, you can believe that over the last couple of years, a lot of institutional investors have revised their guidelines, subject to the regulatory flexibility they have to change those guidelines. For example, Dutch pension funds have pushed to be allowed to hold more than I think the 5% cap. It's a very low cap on their gold holdings. They've been lobbying the government. Anyway, that's one example, but there are others. And then, of course, high net worth investors and just private households generally do not see the world in quite the same way that they did a few years ago. The inflation finally arrived. It took COVID to do it, which was a supply shock, in my opinion, but the monetary debasement was already there to show up in realized price inflation when COVID hit. And so here we are. We're now in a world where everyone's afraid of inflation again. Everyone's concerned that because the debt pile keeps growing, public and private debt pile keeps growing, that further debasement is just inevitable. And so everybody wants to hold more gold in that environment. But beyond a certain point, when it comes to official investors such as central banks, when it comes to big institutions such as pension funds and insurance companies, and when it comes to high net worth investors and private households, the share of gold as your total portfolio has increased so far that it begins to get to the point where the global share of gold assets, liquid gold assets, begins to eclipse the dollar's share. And eventually you reach a tipping point, and people actually start to think, wait, why can't we transact in gold, especially when it's official transactions between countries? Why can't we settle trade imbalances in gold? After all, that's the way things were done for centuries. And why can't we go back to that? So I think that's the road we're on.
Yeah, no, it's such an exciting place to be, and a lot of investors who have been in gold, who have been watching, particularly the accumulation of central banks, the shifting in investment mentality, feel like they've been in that curve, and there are others who are just sort of waking up to it in a way, and that could be where there's more opportunity to push gold. And Morgan Stanley, for example, just announced recently to their retail investors, their high net worth individuals, to consider going with their portfolios from a traditional 60-40 equities to bond split to 60-20-20 with gold and commodities making up that 20. But it's going to take a minute to move those. And also, you mentioned pension funds. There are regulations and restrictions that do need to change. So it seems like there's a lot more opportunity for upside to gold and for gold mining in the future.
Yes, I agree with that. And you mentioned gold mining, and you're well aware that a gold mining firm is not gold. What it is it's a margin business on top of gold. The margin between the cost of getting the gold out of the ground, which is a complex function in of itself because of the type of financing you have, your labor contracts, energy costs, whatever it is, and then of course the price you get for the gold that comes out of whatever hole in the ground or pit in the ground it happens to be. If gold gets to these levels and remains at these levels, and people start to just think, well, this is just the way things are going, the miners are going to benefit even more. And we're in that phase now. The past year was the year that the miners finally caught up, finally began to catch up with what was going on. It almost as if the investing world didn't believe that this rally, this gold rally, was going to be sustained. And yet the miners have now woken up. And that's an important signpost that the world really is changing, that the demand function for gold really is changing. And I've been recommending over the past couple of years, not just to increase allocations to miners, but also other you might call it sort of middle risk tier options, such as the royalty and streaming companies, for example, that also introduce a certain amount of leverage on the price of gold. And a lot of the advisory work that I do is to try and get the right mix for an investor's given risk return objectives between physical allocated metal, royalty and streaming arrangements, the miners themselves, usually major miners. I'm not really a junior miner specialist, but occasionally I get asked about that. And then there's also the gold leasing market, which has been made available to retail now in a way that it wasn't some years ago. So I also advise on that.
Yeah, it's interesting you bring up leasing. That is definitely an up and coming component of that mix that you're talking about, John. Thank you for bringing that up, as well as all of the fountain of information you provided over the years and continue to provide in this space. And before we sort of close, I wanted to get your opinion on some of the other precious metals, on what you see for silver, what you see for platinum, or anything else you might also have your eye on, and what our subscribers and what investors should specifically be considering right now as we end 2025, going into their allocations for 2026 from your perspective.
Well, one thing that we've seen very recently is a spectacular catch up of silver to what gold has been doing. Very, very impressive. If you recall, just 6 months ago, the ratio is still effectively 100 gold to silver, and we're now down to 75. That is a huge swing in a historical comparison. But then let's keep in mind that getting to 100 in the first place was a real outlier. And I did not think that that was going to be sustainable. Silver was clearly being left behind for reasons that I thought did not make fundamental sense. And so here we are. We've seen a huge comeback by silver now, including specifically last week. Now, there are some conspiracy theories floating around regarding precisely why silver's performance was so spectacular last week. I have some sympathy with those, actually, but I have no definitive proof of anything. So fundamentally, silver was undervalued. Regardless, whatever has catalyzed it getting to 75 is therefore perfectly understandable, in my opinion. My longer term target, or medium to longer term target, is 60. If you take a look at the post Bretton Woods average ratio of gold to silver, it's roughly 60. To me, that's a minimum target to look for in the ratio, or maximum, depending on which way you're approaching the chart. And the reason why is because I believe there has been a fundamental demand shift in favor of new uses for silver in recent years, including meditech, including some alternative energy applications. That is, alternative energy applications that actually work, because not all of them do, in my opinion. Silver can benefit from that. And so I think getting back to 60 is a perfectly reasonable forecast here, and we might well get through it at some point. And when it comes to PGMs, platinum group metals, look, quirky markets, hugely affected by shifting demand for auto catalysts. And I mentioned new technologies for silver. Well, yes, you also get new technologies coming along for PGMs from time to time. I have to say, I feel a little bit out of my depth on some of that. The supply side is much easier to understand, but the demand side can be all over the place and subject to regulatory decisions, for example, regarding auto catalysts, emission requirements, things like that. And so I'm going to hold off giving specific views on PGMs here. All I will say is that precious metals in general still have upside. That would include PGMs. And if you want to dabble in PGMs, just understand you're dealing with a volatility that's an order of magnitude higher than gold. And the same is true of silver, for that matter. And in fact, I've done some statistical work on silver. Its upside volatility is roughly double that of gold, but its downside volatility is roughly triple that of gold. And you just need to be aware of the risks you're taking when you move out of gold, which is considerably less volatile, and into the other PMs.
And that is actually really useful advice to follow, John. Just to clarify, when you said 60, you're talking about the ratio gold to silver, and not necessarily silver prices.
No, no, that's right. The ratio, again, it's fallen from over 100 earlier this year to about 75 now. My medium to long-term target is around 60 for that ratio, but I would not be surprised if it even gets through that. That's my sort of initial ratio target. I have been overweight silver for 2 years now, patiently.
Right. And I appreciate that clarification, John. Your work is really so stellar. I'm a really avid reader of the F4 report. Obviously, I got the original version of the Golden Revolution from you. And I really appreciate your perspective. And everybody watching today, really check out John Butler's work. It is stellar. It will keep you a very savvy investor going into 2026. John, thank you again so much for joining us here today.
My pleasure, Nomi. Thank you very much for the endorsement. I appreciate it.
Thank you. And again, for those of you listening, thank you so much for listening to the special episode of Prinsights Global Spotlight.